Hello everyone, welcome back into the channel. If you're new, then welcome. Please make sure that you subscribe and like the video and then share with your friends. Also make sure that you engage with us in the comments if you need any clarity in any of the questions or if you have specific questions maybe that you'd like us to address. Special shout out to all our members at the back. Yes, you can join membership of this channel and then you can basically get exclusive videos, including NBTs, and there's going to be a lot more content that is coming through for the members. It's only for the price of 149 per month, and you will be a member of the channel and support us in the best way possible. Anyways, let's get straight into the question of today. All right, so the next question we're going to be looking at is the interpretation of financial information, still on the November 2023. So this is question 3, and here we are dealing with two businesses. We have Guardian Limited and Navarra Limited. Let's look at the required. So it says here, where comments or explanations are required, you should quote financial indicators and trends with figures, and also give a reason or an explanation for the financial indicators that were quoted. Very important. We're going to be doing those ratios together so that you can see how you should be answering these questions when you're also writing a test, because sometimes people don't exactly know what to say and don't know maybe how long their points should be, and sometimes spend too much time on the questions when not a lot is required. But let's quickly start with 3.1, where we're matching column A with column B. So let's see. So firstly, a director. So let's look at A. No opinion was expressed on the financial position of the company. It's not a director. That's a disclaimer of opinion. It's a type of audit opinion. Next, it says here the person who invests funds in a company, people that invest funds in a company are shareholders. Okay, and then next is manages the operating, financing, and investing activities of a company. Yes, that is true. So then for director, we're going to go with C. So we're going to go with C. And then let's see 3.1.2 unqualified audit report. So the first was an audit report, but that is a disclaimer in A. Sorry about that. So the other thing that is an audit opinion here is basically number D. What does D say? It says the financial statements fairly represent the financial position of a company, and you can see this is without exceptions. With exceptions, it would be a qualified audit report, but without any exceptions, it's an unqualified audit report. So that's going to be D. Okay, and then lastly, we spoke about someone that invests money in a company is a shareholder, and we got shareholder here. So that is going to be B. All right, cool. So that would be 3.1. Now let's look at 3.2, and we're going to be commenting on the liquidity of this business. So it says here, identify the company that is managing its working capital well. Quote two financial indicators with figures and trends. So we have to pick a company that is managing their things better. And then we're going to quote two financial ratios that basically support this opinion. So let's look at these two companies because we have, as I said here, we have Guardian Limited, and then we also got Navarra Limited. So let's look at the financial indicators. So here we got number of shares, and that doesn't give much, but let's go to D. So yeah, financial indicators, market prices of shares and interest rates. So let's look for some of the working capital ratios as well as the liquidity ratios. So this is basically what you got here. Current ratio, asset test ratio, debtors collection period, creditors collection period. The other ratio that I would look for would be the period for which stock is on hand or the stock turnover rate. So those would be the other ratios that could help here. But we got enough because we only need to quote two and we need to pick out the company that is doing well. And this is a 5-mark question. So that means that One mark is for picking the right company, and then the two marks for picking the first ratio and quoting it, and then also another 2 marks for picking the second ratio. Okay, so let's see. So firstly, current ratio of Guardian Limited went from 1.5 to 1.7, whereas for Navarra Limited it went from 2.5 to 0.9. So this is pretty terrible. And then also the asset test ratio, as you can see here for Guardian Limited, it went from 1 is to 1 to basically 1.2 is to 1. Whereas for Navarra Limited, it went from 1.4 is to 1 to basically 0.2 is to 1. So it's pretty bad for Navarra Limited. I think this is an obvious case that Guardian Limited. And then let's even look at the debtors collection and creditors collection. You can see 22 days to 19 days when they actually on this side have 40 days to 65 days. And then also, if you look at the creditor's payment period, in this case, from 48 days to 50 days. Yeah, they've improved by 2 days. In this case, in this one, they improved by 5 days. So, not a very strong one. But the first three, you can quote any of them, they will give you the marks. So, we're going to answer this question by saying, okay, cool. So, we're going to identify the company that is performing better. So, Guardian is managing working capital well. And then we're going to quote the ratios. So this is supported by the following ratios. So we're going to start with current ratio improved from, so it was from 1.5 to 1 to 1.7 is to 1. So you're going to say from 1.5 to 1 to 1.7 to 1. Then you're going to quote the asset test ratio. Asset test ratio improved from, so the asset test ratio was from 1 is to 1 to 1.2 is to 1. So you're going to say 1.0 to 1 to 1.2 to 1. And basically, that is a very easy 5 marks. So 2 marks to quote the ratio, and then also 2 marks to quote the asset test ratio, and then basically just 1 mark for 1 mark for stating that it's Guardian Limited. All right, cool. Let's move then into 3.3. So 3.3, it says financing strategies and gearing. So Guardian Limited, it says what were the causes of the change in debt to equity ratio? Provide two causes with figures. Okay, so in this scenario, well, when we look at debt equity ratio, we look at, we're looking at two things, right? We're looking at debt and we're looking at equity. So if we're quoting two things that may have changed this, we need to be looking at either debt or equity to see if maybe there was a change in debt. We'll quote that change, and then we also look at if there was a change in equity, and then basically quote that change. So let's maybe firstly look at debt. So if we look at debt, the way numbers up here, so if we look at the loans, so you can see that there's a mortgage loan that increased from 3.6 million to 5 million. So that basically increased by 1.4 million. So we're going to quote that. Then we're going to say that. We're going to say mortgage loan increased from 3,600,000 to 5 million. All right. So that's one thing that we can quote. The other thing that we can look at is we can look at our equity to see if maybe there were shares that were issued that could have significantly made an impact into this. Yes, clearly there is, because if you look at the ordinary share capital, in the ordinary share capital, you can see that there is an increase from the ordinary share capital from 12 million to 20,960,000. So that's quite a big increase. And let's look at just above the issue of shares. Well, we can see that there were shares that were issued at the end of the year. Basically, there were shares that were issued. 2 million shares were basically issued by Guardian Limited. So that would have had an impact 100% in the debt to equity ratio. So we're going to say that ordinary share capital ordinary share capital increased from 12 million to 20. So how much is it? It's 20,960,000. 20,960,000. Okay. So yeah. So that would be how you answer that question of how the debt equity ratio would have changed. It would have been impacted by the increase in loan and then also by the increase in ordinary share capital. All right, cool. Let's look at the next question. So the next question is still in 3.3. It says, explain why it was wise for the company to make use of loans. Quote one financial indicator with figures and trends to support your answer. Okay, so now when we approach this question of whether it's wise or not to use loans, what we need to look for is the return on total capital employed, and then what you also need is the interest rate on the loan. So if the interest rate on the loan is lower than the return on capital employed, then that means that we're utilizing the loans that we have effectively, because basically we get money from the bank, we pay 14%, and then maybe we make 20%, right? So that means then that you basically have a positive gearing of 6%. But if it is the other way around, then in that case, you're negatively geared and you shouldn't be using loans and should just pay them off as soon as possible, because in that case, they would be subtracting from the business. All right. So let's have a look then and find the return on capital employed, compare with the interest rate on the loans. So let's see. Return on capital employed is 16.6%. The interest rate on the loan is 14%. So let's look how many marks is this question. This question is just 4 marks. So that means that you need to make 2 points. All right, cool. So you need to quote the ratio, and then after that, explain exactly what that ratio means, and then that's when you're going to get the marks. So we're going to quote the ratio first. So we're going to say that return, because they said quote and explain one financial indicator. So that's what I'm doing. So return on capital employed, or return on total capital employed, increased or improved. It improved. It was from what? It was from 13.5% to 16.6%. So 13.5% to 16.6%. Okay. Cool. So you're going to point that out because now we've quoted the ratio. And then after that, you're going to provide an explanation. So now in an explanation, we'll say that the company, I wrote that wrong. Okay. So Rodke, so we're going to say that Guardian, because I don't want to say the company here because it's basically we want to make sure that we are being specific because there's two companies, and this question, it did say at the beginning that it's towards Guardian Limited. So we're going to say that Guardian Limited, Guardian is positively geared because the company is paying what in interest rate? It's paying 14%. So it's paying 14% interest on loans and generates a return of 16.6% on these funds. Basically, that is perfect, and it doesn't need you to basically to over explain it. It's as simple as that. So I understand that sometimes people feel like they need to say a lot more things, but if you just keep it simple like that, you will be good. All right. Cool. So in the next video, then I'll be looking at 3.4, which is basically looking at Navarra and the decisions around the shareholding and the stuff like that. So I'll see you guys in the next video. Please don't forget to subscribe and share the channel with your friends and leave us a comment, like the video, everything. Cheers for now.